Is inflation silently eating away at your savings? While prices keep rising, the value of your money might be shrinking, even if your savings account is growing. In today's video, we're diving into the real impact of inflation on your finances and, more importantly, how you can protect your hard-earned money. If you're looking to safeguard your savings and ensure they outpace inflation in 2024, stay tuned for these essential strategies. What is inflation? Inflation refers to the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. In simpler terms, as inflation increases, the same amount of money buys fewer goods and services. For example, if inflation is at 2%, something that costs $100 today will cost $102 a year from now. This might not sound like much, but over time, even a small increase in inflation can significantly affect the cost of living and the value of your savings. Inflation is typically caused by an increase in the supply of money or demand for goods and services that outpaces supply. Central banks, such as the Federal Reserve in the U.S., try to keep inflation at a moderate level, often around 2%, to encourage economic stability. However, when inflation rises too quickly, it can lead to reduced consumer confidence, higher interest rates, and economic uncertainty. Understanding inflation is essential because it directly impacts your financial planning. If the rate of inflation is higher than the return on your savings or investments, your money's purchasing power is effectively shrinking. For people saving for long-term goals like retirement or buying a house, it's crucial to factor in the impact of inflation on future expenses and make sure that your savings grow faster than the rising cost of living. How inflation affects your savings? Inflation can have a significant and often negative impact on your savings, especially if those savings are kept in low-interest or non-interest-bearing accounts. The core issue is that inflation erodes the purchasing power of money over time. Essentially, as prices for goods and services increase due to inflation, the same amount of money you have saved will buy less in the future than it does today. For example, let's say you have $1,000 in a traditional savings account that earns an interest rate of 1% annually. If inflation is 3%, the purchasing power of your $1,000 will decrease by 2% over the year, since your savings growth rate, 1%, is lower than the inflation rate of 3%. At the end of the year, your account will have $1,010. But due to inflation, you'll need $1,030 to buy the same goods and services that cost $1,000 at the start of the year. In this case, your savings haven't kept up with the cost of living, meaning you've effectively lost purchasing power. This effect is particularly noticeable in long-term savings goals. If inflation consistently outpaces the returns on your savings or investments, the value of your accumulated money may not be enough to cover future expenses, such as retirement, education, or home purchases. In extreme cases, high inflation can severely erode wealth, which is why it's essential to invest in vehicles that provide returns that at least match or ideally outpace inflation. Otherwise, the real value of your savings could decline over time, making it harder to achieve your financial goals. The importance of higher interest accounts and investments. To protect your savings from the negative effects of inflation, it's crucial to seek out higher interest accounts or investments that can outpace inflation. Standard savings accounts or checking accounts often offer very low interest rates, which means that in periods of higher inflation, the value of your money may decrease in real terms, even if the nominal balance increases. For example, if your savings account earns just 1% interest, but inflation is running at 3%, you're effectively losing 2% of your purchasing power each year. One way to combat this is by looking for high-yield savings accounts or certificates of deposit, CDs, which typically offer higher interest rates compared to regular savings accounts. These types of accounts may not provide the highest returns, but they offer a safer alternative where your money at least grows at a rate that is closer to or above inflation. This helps maintain the purchasing power of your savings. However, if you are willing to take on a little more risk, you might want to explore other investment options such as stocks, bonds, and real estate. Historically, stocks have offered returns that consistently outpace inflation over the long term, despite their short-term volatility. Real estate, too, can act as a hedge against inflation, as property values tend to rise with inflation, and rental income can increase over time to match higher living costs. By choosing accounts or investments that offer higher returns, you can protect the value of your savings from inflation. It's important to carefully consider your risk tolerance and financial goals when deciding between safer options like high-yield savings accounts or riskier investments like stocks or real estate. By making sure your savings are growing at a rate that exceeds inflation, you help safeguard your financial future and prevent your money from losing its value over time. Inflation and long-term investments. Inflation has a particularly pronounced effect on long-term investments, such as retirement savings. When planning for goals that are many years away, like retirement or funding a child's education, it's essential to consider how inflation will erode the value of your money over time. Even if you have a substantial savings amount today, inflation can decrease its purchasing power by the time you need to access it. For example, imagine you want to retire in 30 years with a target of $1 million in savings. If inflation averages 3% per year, the cost of living will have increased by nearly 3% annually, meaning that $1 million in 30 years will not have the same purchasing power as it does today. To ensure your retirement savings are adequate, you need to invest in assets that outpace inflation over the long term. Long-term investments like stocks, real estate, and inflation-protected securities are often better suited for handling inflation. Historically, stocks have provided returns above inflation rates, particularly when held over long periods. This allows your money to grow faster than inflation, helping to preserve or increase your purchasing power. Similarly, real estate tends to appreciate in value over time, and rental income often increases to match inflation, making it a good hedge against rising prices. Additionally, Treasury inflation-protected securities, TIPS, are government bonds that are designed to protect against inflation. The principal value of TIPS increases with inflation, ensuring that your investment keeps pace with rising prices. Although TIPS typically offer lower returns than stocks, they provide a safe and reliable way to preserve wealth in inflationary environments. To protect your long-term investments from inflation, it's important to choose assets that not only grow in value, but also offer the potential to outpace inflation. By carefully selecting inflation-resistant investments and adjusting your portfolio over time, you can ensure that your long-term financial goals, such as retirement, are not undermined by inflation. Strategies to protect your savings from inflation. Protecting your savings from inflation requires a proactive approach to investing. One of the most effective strategies is diversification. By spreading your investments across various asset classes, such as stocks, bonds, real estate, and commodities, you can increase the likelihood that your portfolio will grow at a rate that exceeds inflation. For example, stocks have historically provided long-term returns that outpace inflation, while real estate tends to appreciate over time and can provide income that keeps up with rising costs. Additionally, commodities like gold and other precious metals are often seen as hedges against inflation, as their prices tend to rise when inflation is high. Another strategy is to invest in inflation-protected securities, such as Treasury inflation-protected securities, TIPS, which are designed to adjust with inflation. These securities increase in value as inflation rises, providing a safeguard for your principal. Additionally, reviewing and adjusting your portfolio regularly is crucial to ensure that your investments remain aligned with inflation trends. As inflation impacts different sectors of the economy in varying ways, being flexible and responsive to changes can help you maintain the value of your savings. By combining diversification, inflation-protected assets, and regular portfolio adjustments, you can better protect your wealth from the long-term impact of inflation. Understanding how inflation impacts your savings is crucial to maintaining and growing your wealth in 2024 and beyond. By diversifying your investments, choosing inflation-protected assets, and regularly reviewing your financial strategy, you can ensure that your savings not only keep up with rising costs, but also continue to grow. Don't let inflation erode the value of your hard-earned money. Take action now to protect your financial future. Thanks for tuning in. If you found this video helpful, make sure to like, subscribe, and share it with others who could benefit from these insights. Stay informed and keep your financial goals on track.